And Jeff, now it's time to bring in one of your favorite guests, businessman, financial commentator, Jim Rogers, chairman of Rogers Holdings and Beeland Trust Incorporated. Jim, thanks so much for being back here with us on The Income Generation.
I am delighted to be here. I'm very pleased.
Jim, love having you on the show. You know that. Real quickly, though, the Fed has lost their minds. More stimulus than ever in history. So has Congress. More monetary and fiscal stimulus as a combination. You know, a year ago, pre-COVID, the average person with $1,000 in their bank account has 7 times more than that today because of the stimulus. When do we see the stimulus start to normalize out in the economy? Because right now, inflation is going to the moon.
Jeff, it's good to be old in America now because old people are getting the advantage of all of this insanity. But it's bad to be young. My children are going to have a huge burden to pay. This is not good for America. This is not good for anybody, except maybe a few bureaucrats and a few old people.
But Jim, you know, nobody has to pay for that if the rate on that debt is 0%. They're not even paying principal back. So they've got an open check mentality. But at some point, you're right. The stimulus is unsustainable. Even Jerome Powell said that. So, in your best estimation, when will the economy start to normalize from this massive boost of stimulus we just went through?
Well, right now we're beginning to form some bubbles in the U.S. stock market and the financial markets. The bond market is clearly a bubble. It's never been this expensive in the history of the world. So we're starting to have some bubbles. I would suspect, and my market timing is horrible, I would suspect by the end of this year or next, it would just get too high, and then things will start going down, and we'll have a horrible bear market.
Well, there's no doubt about that. We know that bubble's being created right now. But, you know, I don't buy the Fed's argument that inflation is transitory. I mean, for Lord's sake, a container of furniture went from $3,500 to $10,000 in about the last 60 days. Gas is going crazy, so we're seeing rampant inflation across the board. At some point, you think consumer demand would stop because of that. But it's not, because we're living off the stimulus still.
That's because there's so much money being printed and spent and thrown out the window. Jeff, you should go outside and stand out under the window and get some of the money. That's your problem. You're not getting enough of the money.
You know, Jim, that's not the correct answer we're looking for.
Of course, it has to stop. This is going to end very, very badly. We've never had bonds this expensive in the history of the world because the Federal Reserve keeps buying them. We have staggering amounts of debt in the United States, nothing like we've ever had before. Stock markets are starting to form bubbles. I mean, Jeff, you know as well as I know. I mean, I've seen this movie before. I know it ends badly. And unfortunately, it's going to end badly for a lot of people this time around.
Now, one of the traditional models is that, you know, we'll have another, like certain countries, Austria and so on, after World War I, where all of a sudden the currency gets devalued so quickly, you have hyperinflation. But the reality now is virtually every country is now on a fiat currency. Everybody's in the same kind of boat. So, you know, ultimately, how do you see this playing out?
Well, you make a very good point. Everybody's doing it, so all currencies are being debased, which means to me the cheapest asset. Bonds are a bubble, property is becoming a bubble, stocks are becoming a bubble. The cheapest assets are commodities. I mean, you know, silver's down 50% from its all-time high. Sugar's down 70%. Oil is down 50% from its all-time high. Commodities are the cheapest asset class, and normally, as you both know, when inflation comes, the price of goods goes higher, and rice, cotton, gasoline, copper, those are the things that go up.
But, you know, currencies, when a currency gets debased, it's relative to other currencies. But if all the currencies are getting debased at the same time, then isn't it true that nothing's really changed? I mean, a euro to the dollar is the same. The dollar to the yen is still the same because everything's getting debased. So that doesn't that play in? Is that part of, or am I sounding like the kids today with modern monetary theory, MMT?
Yeah, more money today, MMT, free money. We all want free money, but has to come to an end. Yes, all assets are being debased together. Everybody's doing it. Japan, Russia, China, everybody's doing it. Europe, they're all doing it. But unless unless we now are going to suddenly have a free lunch for everybody, this has to come to an end. At least it always has. It always has in the past. And I would urge anybody who's worried about their retirement or anything else to be aware of what's going on, to watch your show so they can see what's happening out there.
Well, it's always good to stay informed, and our show is certainly one way to do that. And but Jim, of course, I appreciate the plug. As usual, Jim, it's been our pleasure having you here on The Income Generation.
My pleasure. Let's do it again sometime. And be careful. Be careful.